Our next guest says the current economic landscape presents a Goldilocks scenario, but he warns about complacency kicking in. Let's bring in Anthony Saccaro, Providence Financial and Insurance Services President. Anthony, good to talk to you today. So talk to me about the landscape you're seeing right now. What's the concern here about investors getting a little too complacent with how things are?
Yeah, it certainly is all about the inflation numbers, which the inflation numbers then trickle back to the interest rates. And the stock market has presumed that the Federal Reserve is going to raise interest rates in March, and that's pretty much almost off the table at this point. And you would almost think that that would be negative for the stock market, but then corporate earnings have been so strong, and consumer spending is still up, and the labor market is still strong that, the stock market has reached new record levels, despite the fact that the Federal Reserve is probably not going to lower interest rates nearly anywhere as much as they were anticipated to at the beginning of the year. What consumers, I think, the concern that I have is that consumers might be getting a little ahead out of their skis. We get to a point where we start to feel like no matter what, the stock market's going to go up. And there are a lot of consumers out there that are believing that the stock market is a safe haven. It's almost like the new safe asset class, and it will always go up. And that's not the case. There are long periods of time, decades, where the market has been flat. And those periods of time are followed by good decades, like the last 13 or 14 years when the market's been up double digits. So I don't want you to get out as a consumer over your skis and get hit if we do get into another major recession or we have another decade of flat growth, not anything like the last decade.
Yeah, certainly a lot of focus going to be on earnings, and it does still feel like it is Fed policy that's going to be the big driver in the markets. We've got inflation data coming out this week. What's kind of the sweet spot you're looking at right now that will give investors confidence that things can push a leg higher, even if the Fed isn't necessarily going to cut rates until later this year?
Sure. Yeah. Well, interest rates, or rather inflation, currently at 3.3%. I think that stays in that level and it doesn't vary too much from there. That's going to be where we need to be. We'd love to see it come down. The data doesn't seem to show that it's going to come down year over year. Yes. Month over month. No. But it does, if it stays in that area. I think the surprise to the upside could spook the market. That could be a problem and cause stock traders to want to go somewhere else to more of a safe haven. And with the yields still as high as they are, they actually have an alternative. That's something that, 2 years ago, we did not have. The stock market didn't have. So I think that would be the sweet spot when it comes to inflation.
When you talk about aligning your portfolio right now, two scenarios, which has really kind of been the conundrum in the market. Is it about the soft landing or is it about a potential recession still on the horizon, despite the economic data pointing to resiliency in the overall economy? How do you align your portfolio based on those two scenarios?
Yeah, so this recession that's never come, right? And the question is still whether it's going to come or not. If you believe that we're going to avert a recession or we're going to have a really soft landing, and I think that there's an argument for that, then you could focus on a consumer discretionary sector where individuals are, just going to spend more money. I think that's a good way to go. Maybe more growth-related stocks if you believe the labor market's going to stay strong, if you believe GDP is going to stay strong. If, on the other hand, you think that there's going to be weakness in the economy, then you might want to focus on more defensive sectors, maybe healthcare, maybe utilities, maybe consumer staples, something on that order. I like to focus on dividends. At Providence Financial, we focus on dividend income regardless of what age you are. We specialize in people that are working with or in people that are retired that need income. But even if you're younger today, because interest rates are so high and because they're widely anticipated to go down, buying fixed income not only to lock in a high yield, but for a capital appreciation play could make sense as well, too. The first time in decades that that's even been available.
So how much have you been shifting up based off of that play?
Yeah, so normally a 60-40 portfolio has been kind of the tried and true mantra over the decades. Over the last number of years, though, it's been questioned, especially with the younger consumers, where it should be more equities. And I think if you're in your 20s or 30s or maybe even 40s, you could afford to have more than 60% in your portfolio of equities. But today, if you have a 60-40 portfolio, that 40% not only can lock in a higher yield, I mean, you could get a very good quality corporate bonds and 5, 6, maybe even a little higher range than that, and then potentially appreciate your capital on that 40% as well, too, where previously it was not a capital appreciation play. It was all just locking in the high yield. and designed to balance out the volatility you'd have with the other 60%. So I think a 60-40 portfolio, even for someone younger today, is really a great way to go. And if you're older, you may want to shift less equities and more fixed income even.